Welcome to the Deep Dive. Today we're doing our Talk Ticker segment where we really break down the latest earnings calls.
Yeah, get into the management commentary.
Exactly. And today's focus is Bank of Hawaii Corporation, ticker BOH. They just had their call for the third quarter of 2025.
Right. It was pre-market release, then the call during the day. Always closely watched, especially for the regional banks.
Absolutely. BOH can be a bit of a bellwether for stability in that sector. So what's the immediate takeaway?
Well, right out of the gate, the results really showed, I think, a powerful mix. You've got this structural insulation plus this near certainty about where their margins are heading.
Okay, strong frame. Let's lay the groundwork first, though. What did the headline numbers actually look like for Q3?
The market seemed to like it. It was a clean beat, essentially. Fully diluted EPS. Landed at little or $1.20.
$1.20, and that was ahead of estimates.
Yeah, by about 2 or 3 cents, depending on which consensus you look at. Pretty solid.
Okay, and not just on the earnings line, right? What about revenue? Was that in line?
Revenue was actually a slight beat, too. Came in at $182.6 million. Yeah. And that's up, 12.2% year over year. So decent growth there.
But for a bank, it always comes back to the margin, doesn't it? The net interest margin, NIM.
Always. And that's where the story gets really interesting. NIM expanded again, 6th quarter in a row.
6th, wow.
Yeah, climbed 7 basis points just in the quarter, up to 2.46%.
Okay, 6 straight quarters of margin expansion when, the whole industry's been grappling with funding costs. That's significant. That speaks to execution.
It absolutely does. And they underscored that confidence, too. The board declared the same quarterly dividend, 70 cents a share.
So holding steady there. It really sounds like the story isn't just, they're stable. It's more about structural improvement. Yeah.
Precisely. You really have to look under the hood past those headline figures to see what's driving that consistent NIM growth. And that takes us into the deep dive on their core banking engine.
All right, let's get into the nuts and bolts then. The margin story. Net interest income, NII. How did that look?
NII was strong, $136.7 million. That's up a hefty 16.2% compared to last year.
Okay, impressive jump. But what's the mechanism? What's the repeatable thing that keeps pushing that NIM higher quarter after quarter?
It's almost like simple math, the way their balance sheet works. It's asset repricing. They're kind of structurally positioned to benefit right now.
Explain that a bit more. How does that work?
So management broke it down. During Q3, they had about $594 million in fixed-rate loans and investments mature or reprice. Think of it as the old book rolling off.
Okay, $594 million rolling off. At what kind of yield?
Those were yielding, on average, about 4.1%. Mm-hmm. But the crucial part is what they replaced them with.
Right, the new assets coming on.
Exactly. Those rolled on at the current market rate, which was around 6.3%.
Ah, so you've got a 220 basis point spread right there just on the rollover.
Locked in. That differential, that's basically guaranteed NII growth moving forward. It's built into the balance sheet structure.
So the older, lower yielding stuff matures, gets replaced by higher yielding assets. It's like an automatic tailwind for NII. It doesn't even depend on writing tons of new loans.
That's the critical point. It's largely baked in just by time passing. They even quantified it. They expect this fixed asset repricing alone, just that mechanism, to boost their NIM by about 25 basis points per year.
Per year?
Per year. For the foreseeable future. That's like their guaranteed floor for margin improvement.
That kind of certainty. I mean, that's pretty rare in regional banking right now, isn't it?
Almost unheard of. But, margin isn't just assets. Liabilities matter hugely. Deposit costs have absolutely hammered some mainland banks. How's BOH doing on that side?
Good question. How are they holding the line on funding?
Well, their deposit base seems incredibly sticky. Part of that's definitely their market position in Hawaii, dominant local brand. Average deposits actually grew at a 7.1% annualized rate.
Okay, so deposits are growing. What about the cost?
That's the other impressive part. The spot rate on total deposits right at the end of the quarter was 154 basis points.
154 BPS. And how does that compare to the average for the quarter?
It was actually 5 basis points lower than the quarterly average. Costs were trending down into the end of the period.
Huh. That almost seems too good to be true. Is it just less competition over there? What was their deposit beta? That's the key metric.
It was remarkably low, just 28%.
28%? Seriously?
Seriously. You look at many big mainland regionals, they're reporting betas closer to 40%, maybe even 50%. BOH passes through way less of the Fed hikes to depositors. That geographic insulation, the brand loyalty, it's a massive competitive advantage on the funding side.
Okay, so low beta plus the guaranteed asset repricing. Those are two really solid pillars. But it raises maybe the biggest question for banks now, interest rate sensitivity. What happens if rates start coming down?
Right. Management actually talked about that. They modeled out what happens with future rate cuts. And it sounds a bit counterintuitive, but rate cuts might actually end up being a net positive for their margin over time.
Okay, how does that work? Usually falling rates compress margins.
It's about the timing and the structure of their liabilities, specifically their CDs, certificates of deposit. Management said they're kind of expecting maybe 2 more 25 basis point cuts this year.
Okay, if that happens.
Each cut would initially cause a tiny dip in NII, maybe $300,000 per cut. That's the immediate impact as asset yields adjust slightly down.
Right, the initial hit.
Exactly. But here's the kicker. Once rates fall, they can reprice their liability side, that CD book, down much more significantly and relatively quickly.
Ah, the CDs mature and they can offer lower rates.
Precisely. So the net effect after that CD repricing flows through is actually a positive impact on quarterly NII. They estimated about $1.6 million positive contribution per 25 basis point cut.
So the funding cost relief outweighs the asset yield pressure over time.
That's the idea. They lower their funding costs faster than their longer-term asset yields fall. It basically flips falling rates from a headwind into a potential tailwind for them.
That is powerful. It suggests they're kind of set up nicely either way. If rates stay high, they get that guaranteed 25 BPs accretion. If rates fall, they get funding relief.
It seems that way, based on their commentary.
Okay, let's pivot a bit. From the income statement to the foundation balance sheet health, credit quality, how's that looking?
The CEO literally called it a fortress credit position. And honestly, the numbers kind of back that up. Non-performing assets, NPAs, were incredibly low, just 0.12%.
12 basis points, that's tiny. What about charge-offs?
Also minimal. Net charge-offs were running at only 7 basis points annualized. Really pristine stuff.
Okay, those are fantastic numbers. But the skeptic might push back, right? Isn't that just because they operate in Hawaii with its unique high-value real estate market? Are they really managing credit well, or just benefiting from the location?
It's probably a bit of both, but you can definitely see the discipline. They aren't just riding the wave. Look at the portfolio. 93% is Hawaii-based, okay? But 86% of their consumer book is secured by real estate.
Makes sense in Hawaii.
But here's the key number. The weighted average loan to value, the LTV, on that real estate is only 48%.
48% LTV. Wow, compare that to the mainland.
Exactly. Mainland banks might see LTVs creeping up towards 60%, 70% sometimes. BOH has this massive equity cushion built in. The collateral value is basically double the loan amount on average.
That definitely speaks to insulation. What about the borrowers themselves?
Also very strong. The average FICO score for their residential and home equity borrowers is 799.
799 average FICO. Okay, that's top tier.
Right. So it shows they're actively filtering for high-quality borrowers. It's not just passive reliance on Hawaii real estate values. It's disciplined underwriting, too.
Makes sense. Okay, moving on to growth strategy. Management spent some time talking about a push into wealth management. That feels like a necessary move, right? To get more fee income.
Absolutely. They clearly see wealth as a big kind of untapped opportunity for them. They've got this dominant brand. Everyone knows Bank of Hawaii there, but their actual wealth assets under management haven't really kept pace with the growth in, high net worth and affluent folks in the state.
So they feel they're leaving money on the table.
Pretty much. And they're actively trying to fix that now.
How are they doing it? What's the plan?
Seems like a two-pronged approach. For the, let's call it mass affluent segment, they've launched Banco Advisors. It's a new, modernized broker-dealer platform. They partnered with a company called Satara. The goal is better client experience, but also crucially attracting and keeping good financial advisors.
Okay, upgrading the platform. What about for the really high net worth clients?
There, the focus is more on internal coordination, driving cross-marketing between their commercial bankers who already have relationships with successful business owners and their wealth management teams, trying to capture more of that existing client's wallet.
Right, connect the dots internally. But investing in platforms, attracting advisors, that all costs money. What does this mean for expenses going forward?
Yeah, they were upfront about that. It means higher expenses next year. They expect Q4 non-interest expense to be around $109 million, kind of normalizing things.
Yeah.
But for 2026, they're guiding to expense growth in the 3% plus range.
So near-term costs are going up.
Yes, specifically because of these investments in talent and tech for the wealth build-out. They're essentially choosing to invest now for hopefully stronger fee income growth down the road.
Okay, it makes strategic sense. So let's try and tie this all together. We've got pristine credit, we've got this guaranteed margin uplift, and a new potential growth engine in wealth. What about capital and, the stock's valuation?
Capital is another strong point. Super solid. Tier 1 capital ratio is 14.3%. That's well above the regulatory requirements for being well capitalized.
So they're sitting on plenty of capital.
Tons of it. And they signaled they plan to use it, especially, they noted, given where the stock is trading right now. They explicitly mentioned resuming share repurchases this quarter and into next year seem likely.
Buybacks on the table. How much authorization do they have left?
About $126 million under the current plan, so significant firepower there.
Okay. And I noticed they did some balance sheet housekeeping this quarter, too. Something about selling a business and repositioning securities.
Yeah, that was a smart move, actually. They sold their merchant services business, booked an $18 million gain on that sale.
Nice one-time gain.
But instead of just letting that flow to the bottom line, they used that gain, essentially, as cover to clean up their available-for-sale securities portfolio, the AFS book. They sold some older, lower-yielding securities, took the loss on those, but immediately reinvested in higher-rate paper.
So netting the gain against the loss to improve the recurring income, what's the net benefit?
The combined effect, the sale, plus the repositioning, is expected to add about $1 million per quarter to pre-tax earnings going forward.
So that's like, what, 2 cents a share permanently?
Roughly, yeah.
Yeah.
It's a nice little bump to their ongoing earnings power, just good strategic balance sheet management.
Did they touch swaps as well, managing rate risk?
They did. They terminated about $1 billion in older swaps. They ended the quarter with a $1.4 billion portfolio of pay-fixed, receive-floating swaps. This helps lower the average fixed rate they're paying and positions them better if rates do eventually fall. Shows they're actively managing the rate outlook.
Okay, so if we step back and look at the market context, the regional bank ETF, KRE, it's actually had a strong year, up over 22%. But BOH stock is down like 11.5% over the same period. That's a pretty big divergence.
It really is. It suggests the market maybe hasn't fully appreciated the certainty around their margin recovery path, or maybe the quality of their balance sheet compared to peers.
That disconnect between fundamentals and price action.
Exactly. That divergence plus the strong capital plus the clear execution, it definitely points towards potential for the stock to, re-rate higher.
Which brings us perfectly to our final segment. This is Talk Tickers. This is not financial advice segment. Always fun. So based on this deep dive into BOH's quarter, what's the logical but maybe slightly audacious trade idea?
Okay, so given everything we've discussed, the superior credit, the capital strength, that locked-in margin improvement compared to mainland peers, the data kind of points towards a relative value trade.
Okay, which is?
Long BOH, short a basket of comparable mainland regional banks.
Right, long BOH, short the peers. Why specifically BOH versus just playing the sector?
It comes down to certainty, I think. BOH offers things the others just don't have right now. You've got that fortress credit quality, the 48% LTVs. That insulates them from credit worries that still linger for others.
Right, the downside protection.
And more importantly, you have that quantifiable, baked-in 25 basis points of annual NII growth from the asset repricing. It's a known floor for margin improvement that most peers just can't claim.
Okay, cleaner fundamentals, more predictable path. How do you structure the trade to capture that value gap, maybe using that capital strength we talked about?
Well, you lean into that capital strength. They have the high capital ratio, 14.3% Tier 1. They have the $126 million buyback authorization. Management has the means and probably the motive, given the stock price, to get aggressive with buybacks.
So a potential catalyst.
Exactly. That could drive sharp, short-term price movement.
Right.
So the mechanism could be buy the common stock, BOH common, and maybe simultaneously buy some medium-term, slightly out-of-the-money call options.
Adding some leverage for a pop.
Right. You're targeting either a gradual re-rating as the market digests the NII certainty, or perhaps more likely, a sharper move if they announce an accelerated buyback program. You're playing for that valuation gap to close potentially quickly.
Okay, so a solid fundamental story underpinned by that unique asset repricing with a clear potential catalyst in the form of buybacks juicing the stock. A well-reasoned, if bold, idea.
I think the big takeaway from Bank of Hawaii's quarter is really that, stability doesn't mean standing still. They are actively manufacturing margin growth through that structural rotation while keeping just incredible discipline on credit and funding.
Yeah, for you, the listener, the key thing to grasp might be that consistent, almost deliberate execution on the core banking model, helped by their unique position, but definitely driven by management actions. They're showing that even old school spread banking, if done really well, can still produce predictable and pretty attractive results.
And of course, the standard reminder, please do review the company's own forward-looking statements and risk disclosures. This is all for informational purposes only, definitely not financial advice.
Absolutely. Always do your own homework. Thank you for joining us on the deep dive for this Talk Ticker's look into Bank of Hawaii.
Catch you next time.